Hello and welcome to this review of the short answer questions on the final exam in engineering economics for the spring 2018 semester. As you see here, there are seven short answer questions worth 5 points each. In this video, I'll go over the calculations for each one of those and discuss them in detail here. Beginning with the first question, you were asked to compare and contrast engineering decisions with economic decisions, and both consider productivity or efficiency. The physical efficiency in an engineering decision is trying to get the most out of what you put into a system, so a higher ratio of outputs to inputs. Well, the same is true with economic decisions. We're trying to get the most benefits relative to the cost, where the costs are the economic inputs, if you would. So for this question, you essentially say they are the same, but we contrast them just in what we're comparing. So that is, they use the same methodology, but they just contrast in how we're measuring the inputs or outputs. The second question says a printer costs $900. Its salvage value after 5 years is $300, and annual cost of $50 to keep it going. If our minimum acceptable rate of return is 8% or 0.08, what is the equivalent uniform annual cost? Well, we can first calculate the present value of both the salvage and these monthly costs in terms of payments at a given interest rate and time period, 5 years. From that, we can see what the net present worth of the project is given its initial cost, and then using that to convert that value into an annual. So what would be equivalent across these 5 years in terms of annual costs? Well, it'd be the same as spending $224.27. Question 3 says a company is planning to add a new diagnostic machine that will cost $20,000 and require annual maintenance expenses of $5,000. It's expected to last 5 years as well. If the net cash flow the company receives is $10,000 higher each year while operating this machine, what's the IRR? Well, the internal rate of return is the discount rate that would give the project a net present worth of 0. So we can do the present value factor for each and find that IRR. Conversely, we can also find the IRR of those actual cash flows for each period. So if we're getting $10,000 more but costing $5,000 expense, we're netting out $5,000 a year, and so we could do the IRR of just that series of cash flows and get the same value with a little bit of rounding there. Okay, now turning to question 4, which reads on the exam, a company purchased a machine for $1 million with a useful life, again 5 years, and a salvage value of $10,000. What is the present worth of the MACRS depreciation, modified accelerated cost recovery system, for the company if we require a 7% rate of return? Well, so we look at the MACRS depreciation schedule, and if you recall, salvage value is always ignored. So we just do the ratio or percent each period. A 5-year life means there's going to be 6 periods, and then we can take the present value of each of those deductions and see what they're worth. Well, in present value terms, it's $1 million we're spending, but given the interest rate, we're going to offset about 831 in terms of depreciation expenses. It's just, again, taking the depreciation, the present value of those depreciations. So you can think of that as an offset against the revenues that we would have for it. We're going to pay that much less in taxes on a present value terms. Question 5 says your $10 million firm can currently borrow at the current rate on AAA rated bonds of 3%. Your shareholders or equity investors expect a 10% return. If your firm is capitalized with 40% debt and 60% equity, what is your weighted average cost of capital after taxes when the corporate tax rate is 15%? So the 10 million is kind of irrelevant because you simply know the ratios of that value, 40% and 60%. So you're going to use those as weight against both the cost of equity and the cost of debt. But considering that the interest on debt, this 3%, is tax deductible. So we see that here, multiplying that weight on the debt portion times 1 minus the tax rate will give us the after-tax cost of debt. And then the cost of equity, the 10%, is simply weighted at the 60% weighted. So overall, that's a weighted average cost of capital of 7%. Question 6 says your firm has decided to purchase a new $50,000 machine. You can pay now and take a 3% discount, meaning $48,500. Or you can pay $11,500 each year for the next 5 years. What is the interest rate at which the two alternatives are equivalent? So a couple of ways to go about this. It depends on when you assume you're going to start paying that $11,500. If you're going to pay it sometime during the first year, then you can simply compare the initial cash flow to those future outflows, 5 payments of $11,500, and then find the interest rate that gives that a net present value of 0, or 5.96%. Conversely, here again, I could do the IRR calculation that I did on the earlier problem, and we'd get that same value, 5.96%. Alternatively, you might have assumed that these $11,500 start immediately, and I believe that would lower your interest rate a little bit. Either way, you're calculating what the rate is, essentially, that you're being charged on this loan, the $11,500 payments for 5 years. Finally, question 7 asks you to put together the net present worth and the benefit cost ratio analysis. So you're evaluating 3 alternatives, and they're mutually exclusive. So that's helpful to know. And they have 25 years each, and you're looking for a 15% return on each. So the same useful life makes the relevant present worth analysis more straightforward. Which project would you choose and why? So we can first calculate the net present worth of each project. So we take the present value of the annual savings and annual costs, as well as that future salvage value, and we deduct from that the initial investments. So that gives us the net present worth. The benefit cost ratio does the present value of the benefits, which include these savings, are just these savings, sorry, and then the cost, which are reduced by the salvage value that you're going to get out of the project. So looking here, we have the initial cost and then the annual cost, but we also have this future value, which is the salvage value, which is an offset of those costs, if you would. So taking those two in comparison, we get the benefit cost ratio. So if I'm using benefit cost ratio, I'm going to get rid of option B, but I would have done that anyway because it has a negative net present worth. This project does not produce enough savings to justify my 15% required rate of return. But notice here that if I'm using benefit cost ratio, the size of project C is hurting it and would suggest that you go with project A. But net present worth is a better analysis in that the project C is going to create the most value for your organization. So under net present worth analysis, which is the better economic analysis, then you're going to go with Project C because, again, that has the most value, even though the relative benefits to cost in Project A are higher. So that concludes my review of the short answer questions. If you have any questions about how your exam was scored, please call or stop by my office. Thank you.